let's welcome on board Jignanshu Gor, Director and Senior Research Analyst at Bernstein India, to analyze Eternal's performance for us. Jignanshu, great to be speaking with you today on the show. Morning as always. Jignanshu, interestingly, you've maintained your outperform call, but you've trimmed the target price to now 350 from the earlier 370. What did you make of the numbers, and especially the commentary? I mean, talking about competition increasing, growth moderating, the path of margin expansion looking a little bit wobbly. Is that unnerving you?
First of all, thank you so much for having here. It's always a pleasure. 3 points. Point one, on performance, they of course came in a little short on the estimates of the sell side on quick commerce growth for this quarter, but they surprised on profitability. Internet companies generally in India are rewarded for growth surprises rather than profit margin surprises so far. I think investors still love growth more than margins, which is what companies then optimize for. Having said that, we do believe that this growth is higher quality and healthy when you look at the operating metrics underneath what makes the headline growth number. On the other two parts, one is on the guidance for growth and the guidance for margin. The reason we do believe the guidance on margin is achievable, we are a little bearish on the margin for growth versus management guidance. So versus a 60% management guidance of quick commerce growth, we are at roughly 50%. But we also believe that the margins can be achieved much closer. So we are sort of 5-10% off of their overall margin estimates. The reason we cut the target price is we do believe that the amount of competitive intensity and capital commitment from all the other players will keep a ceiling on the upside for some time.
More positives than negatives, it seems, Jignanshu, from a store count expansion perspective, from even a guidance perspective. What really stood out?
I think the boldness of the guidance to provide a 3-year guidance at 60% CAGR when your last quarter CAGR is 95% was, I think, bold. It exhibits a lot of confidence in the ability of the company to find different growth vectors. So even if they face competition in one area, let's say in grocery in large cities, they can double down on non-groceries in those cities or to expand customer wallet or go to new cities. And I think that's what was missing when most people compare quick commerce with food delivery. Quick commerce has those additional vectors of growth which food delivery did not.
But Jignanshu, tell me, this softness seen in the quarter in Blinkit's NOV, are you foreseeing a recovery soon?
Yes, we do believe the next quarter should be a recovery. Typically, Q4 is a soft quarter seasonally. It comes off the high of a lot of non-grocery spends across sectors. And we've written in the past that quick commerce is becoming closer and closer to e-commerce. So festive season matters more as more people spend on non-grocery items. So there is a softness typically. And we expect that to go back to around a 15% quarter-on-quarter growth for first Q.
And what's your read-through into the dark store addition for Blinkit and the cash expenses leading to that? Because the management has guided 3,000 stores by next March. Do you believe Eternal is on track for this?
Yes, we do expect them to be able to get to 3,000 stores. However, the shape and the nature of the store expansion will change. So if you divide it into 3 phases, I think the first phase of Eternal till about 1,000, 1,200 stores was about land grab in the top 10, top 20 cities. The phase after that was experimentation in tier 1, tier 2, and densifying the network in metro cities. The phase 3 from here on, we expect it to be primarily from tier 1 and tier 2 cities. So the capex per store should be stable. The store should become a little larger as they want to put more SKU mix in those smaller cities. But we think they can get to 3,000 dark stores.
Jignanshu, the guidance of 5 to 6% with regard to Blinkit in terms of EBITDA margins, what's the downside risk to that? Of course, one is competition, and if competition ramps up or rather continues. But now with size and scale playing out, even that is lesser of a risk, right, from an Eternal standpoint. So So therefore, where do the risks come from with regard to this 5-6% EBITDA growth? It's EBITDA margin kind of guidance. And is it too ambitious? Is that one of the risks?
Yeah, I think, see, this guidance makes a lot of sense when you talk about the top 8, 10 cities in India, where the population density is high, the demand for quick commerce is far more concentrated in localities, the ability pay to pay is high, and so on and so forth. Just tailor-made markets. When you go outside, we expect this achievement of margins to take much longer, as the companies also realize the kind of customer behavior that exists there. So the mix is the key risk in our view. And hence for F29, we build in around 3.3 to 3.2% margin at a network level. We are nowhere close to 5%.
Okay. Jignanshu, thank you so much for coming in and speaking with us. Great chatting as always. There's also Sapphire's numbers, but we'll give that a skip. Thank you so much for coming in and speaking with us.
Of course. Thank you so much, guys. Cheers.
All right. And what we'll do, viewers, is slip in a very short break, come back, continue coverage. Stay with us here on ET Now.